As the second quarter of 2022 ends, investors hold their collective breath to find out if we are in a recession, what the experts are saying, and why it matters in this week's fastest 4 minutes in finance. Hello again, I'm Scott Inman. Recession is a scary word for investors and even more so for workers. So before we dive into the likelihood of it happening, let's start with what exactly a recession is. And that's not even universally agreed upon. Generally, a recession is a term for a prolonged time of declining economic activity, usually lasting several months. More specifically, a recession is traditionally declared after 2 consecutive quarters of economic decline, as measured by GDP. Well, GDP unexpectedly fell 1.5% in the first quarter of 2022, so if second quarter GDP is negative, we would be in a recession. But most economists don't believe that will happen. A survey of 49 U.S. macroeconomic experts at the beginning of June found that 70% believe there will be a recession in 2023, but only 1 believed it would happen in 2022. First Trust chief economist Brian Wesbury points to positive economic indicators to predict 2% GDP growth in the second quarter. Well, from an investor's perspective, it's important to remember that we won't know if a recession is coming until we are already in it. And there's a good chance the stock market has already priced in most of it. Wesbury believes the market is currently fairly valued. His group uses a formula that's tied to treasury yields to determine this. Well, if that's true, it implies that much of the damage has already been done in the market. When second quarter GDP numbers are released, it should not be the time to panic. Wesbury believes corporate profits are still growing. If interest rates don't go much higher by year end, he thinks we could see a nice recovery in the market. But he is cautioning that an economic slowdown is coming in either 2023 or 2024. Again, though, some perspective for investors. If that's true, how should you respond? Well, since 1900, the average length of a recession is 15 months. That makes the point that we make all the time. Equities should be considered long-term investments. If you buy a stock or a mutual fund and you intend to hold it for at least 10 years, the historic track record says you will be rewarded. But if you jump off the ship while it's taking in water, you could end up at the bottom of the ocean while the ship is repaired and sails on to its destination. This should also be a reminder that if you are nearing retirement and need your assets for income, you should not be getting income you need today or even for the next few years by selling stock. A diversified portfolio and a retirement income plan detailing where you get your income and how can be the remedy for recession. Thanks for listening.